Bim, folks, what's up? Nick Masunda here. Video number 14. I'm going to be talking about term life insurance policies versus life insurance policies with cash accumulation accounts, such as whole life insurance. Why should you watch this video? Well, I've been working in life insurance and personal finance for the past 7 years, and hopefully I want to impart some of that knowledge on the viewer and help you make more informed decisions about your own finances. So in this video, I'm going to explain what these policies are, the differences between them, the pros and cons, and some of the pitfalls to look out for when you're considering your own life insurance. So let's start by just describing what a term life insurance policy is. So 9 times out of 10, if you're looking at a policy in Australia, it's going to be a term life insurance policy. They call them term life insurance because you're insured for a period of time. Usually it's up to about the age of 99 or 100. And you will be covered for the risk of dying only. There is no cash accumulation account. Okay? So this is comparable to any other insurance policy. Let's say car insurance, for example, where you're insured for the event of crashing your car, right? You pay for your premium for a year. If you crash your car, the insurer pays you. If you don't get paid. You may end the policy after a year and you and the insurer go your separate ways. There's no money coming back to you. Okay, it's exactly the same with term life insurance. You pay for the risk of dying. If you don't die while you're covered under the policy, you don't get any money. And when the policy ends, you don't get any money. There's no cash accumulation. Okay, so that's term life insurance. The alternative is these life insurance policies where there's a cash accumulation account, such as whole life insurance, universal life insurance, endowment policies, etc. They all have slightly different terms, but fundamentally the similarity is you're paying the insurer a premium. Part of that premium is covering the risk of dying, and the balance of that premium goes into a cash accumulation account that's managed on your behalf by the insurer. Okay. Now, there's a couple of issues with the style of policy. The first one is that they may or may not guarantee a certain return. Okay, if they do guarantee a return, it's generally going to be pretty conservative. If they don't, it seems like the general consensus by commentators on these sort of policies, typically in the USA where they're available, is that the returns are pretty underwhelming. Okay, so there's a couple of issues straight off the bat. With whole life insurance policies in the States, the United States of America, you can, if you do take out one of these whole life insurance policies and you're paying into the cash accumulation account over the years or decades or whatever it may be, and then you eventually die, your family will receive the insurance amount, the cover amount only. You will forfeit the cash accumulation to the insurer. Okay? That is also problematic when you consider the alternative, which is that you simply go and take out one of these term life insurance policies, which are going to be cheaper because you're just paying for the risk of dying. And then you go and put your money into an investment account, which doesn't get forfeited to any party. It goes to your family. So you get the best of both worlds in that situation. So given that alternative, it makes term life insurance whole life insurance not as an attractive option. Okay. Now there's some other aspects about tax which I'll talk about a bit later in the video as well, but that's sort of an overview of term versus insurance where you do have a cash accumulation. Now, whole life insurance policies in Australia, they pretty much became obsolete when superannuation was introduced in 1992. I don't know if you can actually get a whole life insurance policy in Australia any longer. The most similar thing that I'm aware of is an offering from PPS Mutual. Okay, they haven't been in the market that long, but basically they do retail life insurance. So something comparable to what you may get from TAL, AIA, MLC, etc. Now with PPS Mutual, basically you have your premium that you pay to the insurer, part of that covers the risk of dying, and part of that goes into a profit share account, what they call profit share account. Basically, this is the cash accumulation account, parallel to a whole life insurance policy or any other life insurance policy with a cash accumulation account. They take that money, they invest it, they manage it on your behalf. Okay. Now, in the case of PPS Mutual, they don't really tell you how it's being invested, from what I can tell. I mean, unless I miss something in their materials, and they don't guarantee a return. Okay. They haven't been around in Australia that long. I don't know what the kind of returns people are getting on their profit share accounts, but I mean, they're probably underwhelming would be my guess. So anyway, be interested to see some materials on that if anyone has it. But one positive with PPS Mutual that I will mention, positive relative at least to whole life insurance policies that I just described, is that you can die, get your cover amount paid out, and still get the cash accumulation account. Okay, so that's obviously a big positive. The downside is, and this is typical of these cash accumulation life insurance policies, is you're restricted on how and when you can get the money in the cash accumulation account. In the case of PPS Mutual, you can only get the full amount when you've had the policy for 20 years, or you reach age 65, or you pass away. Okay, I think there's a few other events, but it's restricted. You can also get 5% per year after you've had the policy for 10 years. Okay, so now, one of the positives tax-wise that I mentioned earlier I was going to talk about is that the money from the cash accumulation account or profit share account, whatever it's called, is tax-free. It's completely tax-free when you do eventually get hold of it, or when your beneficiaries get a hold of it. Okay, so just in case that was something that you guys were thinking about, like, okay, yes, I can take my money and go and invest it in an investment account, but that's not going to be tax-free when I eventually take the money out. That I'm going to have capital gains owing on it. Okay, and that is true. So a proper alternative to taking out a policy with PPS Mutual would be to have that money invested in a tax-effective vehicle. So you've got a couple of options when it comes to this. Okay, and just to be clear, I'm talking about you get your life insurance with an insurer that's offering a term policy covering the risk only, and hopefully that's more price competitive. And then you take the rest of your money and you invest it independently with an investment account. Now, where are you going to get comparable tax benefits? You're going to get that in superannuation. Okay, again, it's restricted, but earnings are going to be taxed at 15% generally. And when you reach a condition of release, you can go into pension phase and withdraw the funds, the proceeds, tax-free, no capital gains tax. The other alternative is to invest in an investment bond. So with investment bonds, that's outside of the super environment. It's taxed within the investment bond, similarly to super, but it's taxed at 30% rather than 15%. But after 10 years, you can access your funds and capital gains is waived. Okay, so that would be the alternative to a PPS Mutual policy in this case. So that's not to say to never invest with PPS Mutual. Of course, if you found that you got a really competitive PPS Mutual policy and you were getting a cash accumulation account, I mean, if you're comparing that with a term life policy where you're only getting the risk and the premiums are comparable, it's kind of a no-brainer to take out the PPS Mutual, because it doesn't really matter what kind of return you get on that profit share account, that cash accumulation account, because the alternative would be to have no cash accumulation account at all. All right? So there could potentially be situations where a PPS Mutual policy would make sense, but at the end of the day, the main thing is making an informed decision and knowing the terms of the policy and what you're getting yourself into, because it is a long-term commitment. So yeah, that's pretty much my 2 cents on the matter. I think that's pretty much it. Thanks for watching, guys.